All right. Thank you all for attending this month's market update webinar. To start, let's start with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed within the presentation. And of course, past performance is not indicative of future results. You can see our website for additional disclosures. And throughout the webinar, please use the Q&A button at the bottom of the screen and submit any questions you have, and I'll address them at the end. Quick background about myself. My name is Jeremy Eppley. I'm a chartered retirement planning counselor, accredited portfolio management advisor, and accredited investment fiduciary. And if you'd like to learn more about myself or my experience, you can check out my LinkedIn. And Silverstone Financial is a fee-only fiduciary RIA firm. We provide wealth management and financial planning services. To learn more about us, you can check out our website, silverstone.financial/about us. A couple of changes are coming to our webinar in 2023. I'm planning on switching it to the same day instead of being on the first of every single month to being the first Tuesday or Wednesday or Thursday of every single month. I'll be sending out a survey, most likely tomorrow. So please look out for that. I love to hear which days do or don't work for the majority of your schedules. I'm also considering either moving up the presentation from 6 or moving it back until 7. Right now it's 6:30 p.m. Eastern every single night, or every single month, rather. And just want to make sure that it is as accessible to the most amount of people as possible. So please look out for that survey. And another additional point is that when you registered for the webinar series for 2022, you opted into all of each month a webinar. And since it will be a new schedule for 2023, you'll have to re-register if you'd like to continue to attend these market update webinars. All right, let's hop into some notable events from last month. One of the major ones, of course, were the US midterm elections. There ended up being a split Congress, so there was not a red wave that was anticipated earlier on by many political commentators and such. I'll discuss later on when we talk about this month's performance about the impact of elections on the markets. Since then, we had some notifications and some news concerning student loan forgiveness. Since there have been a lot of court challenges, the Biden administration has implemented a pause on payments until June of 2023 for the Supreme Court ruling. And just today, we got the announcement that the Supreme Court will be hearing the case, will be listening to arguments in February. So most likely March or so, we should have a ruling, and all those of you that have student loans will have an answer whether or not you need to start paying them back, or if you'll have a forgiveness on all or a portion of your current student loan balance. Another big finance event has been the eruption of layoffs in a lot of the big tech names. Of course, Twitter, if you followed the Elon Musk situation with his acquisition of Twitter and then reordering of the organization, should we say, where there is quite a huge firing and or quitting of the staff. But it's not only isolated to Twitter. There have been layoffs in many companies, Meta, Amazon, I believe Google and such. It just essentially they had overhired when all the money was cheap, essentially, with low Fed rates. And of course, course, they've been growing considerably over the years, so they've amassed quite large workforces and very expensive workforces. So there has been a reversal in that, so layoffs and some of the early indications of a possible recession. But in general, I believe most commentators are now leaning back and have a reduced recession fear, less likely, not 0%, but less likely that there'll be a very significant recession in 2023 with all the layoffs that are currently being seen in the economy, mostly being isolated, not completely, but mostly being isolated to these high-paying tech jobs, which most of the people there will likely be able to parlay their situation to another job eventually. And since they have higher paying jobs, usually they have more savings. So there should be less of an impact on the economy rather than, say, Walmart announcing huge layoffs on their workforce. That would be more significant to the core foundation of the economy. The other big graph I want to point out that I include on this page was the Q3 numbers for GDP. They were re-rated this month, so they came out, and when they came out, it was set at 2.6% for Q3 growth, and it was re-rated with a better estimate with more data to a 2.9% GDP growth, which is good to see. There was a lot of talk about, oh, we're already in a recession after the Q2 GDP data came out. The technical definition of recession, of course, is 2 consecutive quarters of negative GDP growth, which we technically had, but a lot of the commentators and rating agencies and such never actually fully announced that the US was in a recession, mostly because there wasn't significant, it wasn't huge losses like we saw in 2008. And it was ameliorating in Q2 and has fully reversed in Q3. So we'll see if Q4, Q1 of next year, Q2 of next year, if there'll be growth problems, if there are widespread layoffs, if it's a contagion effect where what's happening in Twitter and Meta and Google and these really large mega cap name companies continues and spreads into blue collar jobs or low paying hourly workers, that could cause a larger recession. We shall see. Another big headline news in finance was the FTX scandal that came out mostly all in November. Yeah, for those of you that followed, I won't go too in depth with it, but essentially it came down to FTX and their sister company, Alameda Research, which was a hedge fund, I believe, or at least a market maker in a lot of crypto. And they had commingled funds in a fraudulent manner. Whether or not there was intent or just mismanagement by FTX is up to the courts and will be decided in the future. But it caused huge shakings in the crypto world, mostly because FTX was considered one of the safest, one of the most trustworthy large crypto firms. And it was a big shock to the world that their founder, Sam Bankman-Fried, who was seen as an altruist person, who was trying to save other troubled companies by giving them influxes of liquidity and such, who most likely caused one of the largest fraud scandals since Bernie Madoff with his Ponzi scheme. So I am very interested in seeing how it all comes down. No one's been arrested yet, but there's a good likelihood that eventually that may happen. For those prospects and clients of mine that I've had numerous conversations with about cryptocurrency, this is one of the reasons that I'm not a big crypto bull. I definitely see quite a lot of risks involved in investing in cryptocurrencies, especially the smaller cryptocurrencies, and especially a lot of these unregulated companies that are essentially printing securities without any backing of the IC or the Federal Reserve or anything like that. So I continue to only endorse, and in small numbers, a small portion of portfolios, possibly holding Bitcoin. But beyond that, cryptocurrency is difficult to recommend. It's still very speculative and, most importantly, unregulated, as we see with the scandal space. So invest with your own risk. And lastly, there's a whole lot to talk about for the Federal Reserve. As those of you who come to many of these webinars know, I probably go too in depth in what the Federal Reserve is doing each month, but they're very important in how the market functions and how we can expect future months to perform. But that may be changing, which I will talk in a few slides. So, future Fed expectations. In November, we got what we expected. We got a 75 basis point hike. It is now expected that is the last very large hike in interest rates. There's the expectation, especially with a lot of Fed verbiage and how they're communicating with the public, that they are going to slow down rates hikes. They're still going to raise them, but slowly, and eventually stop, and then eventually one day potentially cutting. I think overall, a lot of the market and commentators are too focused on the Federal Reserve. Oh, they're going to start cutting rates very soon in 2023. And that's not how I see it, especially how they have communicated that they want to raise rates and then hold rates to see what happens. So most likely we'll see in December, I think it's the 14, 15, 16th day of December, while the Fed meeting, most likely they're going to announce a 50 basis point hike. In January, we'll see probably a 25 or 50 basis point hike. February, 0 or 25. And there's a lot of expectations that will be it. Already, this is much higher than previously expected, which caused quite a bit of pain in Q3. There was over tightening fears, which I definitely shared my worries about, but we will see. And so far, inflation has begun to ameliorate, which we will talk about in a few slides. So year to date, 2022, performance of the market. For those of you that are new here, this is how I see the market every single day. I feel it's much more information rich than just a normal S&P line graph that you may see. The larger the box, the larger the company size. So Apple is larger than every other box on this screen. We'll see is split up by the 11 sectors, and the brighter red the company, the more losses it had in the period, and the brighter green, the more gains it had in the period. So this is year to date, so 11 months of performance, and we see energy still being top dog because of the the huge spikes in gas prices and such. In healthcare being the other pretty good place to keep your money, because in general, healthcare is pretty good inflation hedge because people need their healthcare no matter what, so they can charge what they like. So usually healthcare is another good place to be. Going over year-to-date performance on some of the indices, we see pretty significantly the Dow Jones having outperformed the rest of the market, even outperforming bonds, which some of you may be surprised to hear, since oftentimes you hear bonds, you think bonds are safe. You can't lose money on bonds unless they default. Well, actually bonds, especially bond funds, fluctuate just like the rest of the market. They just have lower volatility, so they fluctuate less. However, in an inflationary environment where rates rise, bonds are inverse to rates. So since rates rose very quickly, bonds essentially in finance terms were required to fall, versus value companies, which the Dow Jones Industrial Average mostly has, isn't required to. It doesn't have as much effect on what's called the duration of the security, but we still see it having fallen just like the rest of the market, but outperforming. S&P for year to date, 14.4% down. Mega caps being the worst among here, other than Bitcoin, being down almost 20%. So that's your big names of Google and Apple and Facebook and Tesla and Amazon, mostly being led by Meta or Facebook, and Tesla and Amazon not too far behind. Small caps have held up much better than some other indices, which is surprising to some, especially since small caps are often seen as riskier. But as many commentators would tell you, a lot of the mega caps and the large caps and even the big caps got over their skis. They were overbought during the frenzy of 2020 and such in the pandemic, and the small caps moved less. So since they rose less, they should fall less. So that's kind of the explanation there. Gold still down, crude oil still slightly up, but it's not as high as it used to be. And Bitcoin down 62% for the year, which is the big loss. And Bitcoin it's been surviving much better than a lot of the other coins out there. Ether, I believe, is worse, and all the other minor coins that have no intrinsic value in my mind some of them are down 99% or 100% in terms of at least the FTX tokens and such that are worth nothing now because of the scandal. November, this month, slightly greener since this month was pretty good and it's a shorter time horizon. Apple, Amazon, and Tesla, Disney being the big disappointments. But we see Dow Jones up 5% in a month. That's quite significant. S&P 500, 5% a month. You don't see those moves that often. The big, I don't know about surprise, but big upset was the global economy or the global stock market rather, having gone up 11%. They have chronically underperformed this year compared to US markets. And I believe just since they were so underbought in the past 11 months, this month was their catch-up month where their relative value comparison to the US market. I don't think there's something inherently wrong with the US market right now. It's just they were not bought to the extent that they should have been. So a little catch up, but they still have underperformed the rest of US markets this year, as I've explained in previous webinars. Bitcoin down 16% just this month, pretty significant. Crude oil giving up 7%, which is significant going into winter. There's a lot of worries that it was going to shoot up again in winter when everyone has to heat their homes and such, especially in Europe. There's a lot of worry there. Bonds up, gold having a good month finally, even though it's been down some. I wanted to remind those of you about the cyclical cycle, month to month. What is the average return of that month? September having been on average a bad month, and our September being bad this year too. On average, November and December being the best months of the year. And surprisingly, or not surprisingly, we got a very good November, although historically we outperformed November and we had 5%, 4 or 5% returns. On average, it's just a 1.5%. So we'll see if maybe we overshot in December and not get that seasonal rally. But as I'll explain in a bit, I would expect, unless there's big bad news coming out in December, that we will have at least a slight rally and likely the Santa Claus rally to close out the year and bring us closer to flat. Which, if some of you remember, some of my earlier webinars was what I predicted. Flat, slightly down was what I was saying at the beginning of the year. All right, and this is the last slide that I want to talk about today, which is the classic S&P 500 line graph. Some of you may not be familiar with candle charts. Instead of just a normal graph, this gives a little more information with if the day was down or up based off of red or green, and the wicks are showing the volatility for that day, which is pretty helpful for someone that's looking at the market and wants as much information as possible. So it might be a little hard to see here, but I'll explain all the annotations. In this box at the end, November, I put 4 arrows. And each of these explains some important events. So the first arrow, this purple arrow right here, was the Fed rate hike announcement right at the beginning of the month with a raise of 75 basis points. Now the 75 basis points was expected, so that shouldn't have caused a sell-off. It was a pretty significant red candle down on the chart. However, it was after the actual announcement when Fed Powell had his speech, he came off very hawkish and worried the markets that he would over tighten and cause a recession where there wasn't need of a recession. And so there was a big sell-off there, which kicked off November to a pretty rocky start. This blue arrow, not that much is happening right here. There's a lot of trading back and forth, but not huge moves within this little bundle. You might be surprised to hear this is actually the midterm election. This green line was the election day, red line was the second day when we had the information about no red wave, and there was a slight sell-off, but it wasn't significant. And this is a point I want to make. I was explaining it in October. I had some questions about the impacts of elections. And every time there's an election cycle, as an advisor, I hear questions about, hey, if the Democrats win, is the stock market going to crash? If the Republicans win, is the stock market going to crash? And I've said it in the past that the best performing periods are when there's a split Congress and no one has power, because the stock market and business likes homogeneity, where there isn't a lot of change and they can make strategies without worrying that lawmakers are going to break those strategies. But on top of all that, the stock market on average goes up no matter who's in power. So when there was confirmation that there was no red wave and the Congress is still split, we saw not much happen. And the next couple days, this orange line, this some people would attribute to at least somewhat the election. But the bigger cause of this big green spike, which was a great day for the market, I forget how much we were up, it was like 6% or something, it was one of the best days historically, was the October CPI report. So that's inflation. And it came in significantly lower than expectations. Inflation finally moderating. And that was great to see, especially since there was upsets, or at least over inflation, over expectations in past months, which caused lots of worries that the higher inflation is going to be, the more Jerome Powell and the Federal Reserve will have to raise rates, which means there's going to be more impact on the economy and cause for recession. So a good first final step in the right direction where inflation fell significantly. And we're hoping that in December, we will see another great inflation read dropping again. For this fourth arrow, this purple arrow, is again the Federal Reserve, just like over here. They didn't make a rate hike announcement, but Fed Chair Powell had his speech, and he came off and rolled back some of his comments and came off a little bit more dovish, and not significantly, but not as we're going to destroy the economy to destroy inflation, that he came off a little bit more in that tone at the beginning of the month. And so that's where we're starting off this month with a good, I guess, positive outlook that inflation is being beaten and the Federal Reserve is not going to have to raise rates significantly until there's a recession. Now, one call I'll make, or prediction I'll make, is that all of these months, when I had my webinar, we would focus mostly, or at least I would focus mostly, on the Federal Reserve and their announcement and their rationale and their speech afterward. And are they going to raise rates? How high? How bad is it going to be? And I think that is shifting. This entire year, the market has been dictated by what the voting members of the board of the Federal Reserve ended up going into a room and saying what they were going to do, and they were controlling the market. This entire move was essentially predicated based off of the Federal Reserve, and then this entire move was when they reversed and they decided to raise rates more significantly. These are huge moves in the market, and basically the market, there were fluctuations and based off of other conflicts and such, but mostly the market was being driven by the Federal Reserve. Now that we're finally getting to the end of the rate hikes, where the Federal Reserve is mostly going to stay flat, and they still are going to have power, staying flat is significant rather than cutting rates, so it's going to affect the markets. But the biggest new impact on what's going to drive the markets is going to be each month's CPI report, the inflation report. If inflation is good in December, we're going to see a big rally in December. And if the inflation report is really bad, it was that November's inflation was just a fluke, then we can see quite a big sell-off, and it will all be dependent on that inflation data. I'm hopeful, since there's a lot of leading indicators that you can see in the economy that would tell us inflation is coming down and it's a trend, not a fluke, and that December will be good. So I do expect that we'll have a good read and we'll have a good rally for the end of the year. But no guarantees on that. We will see. I want to discuss also about these two lines I threw on here. This bottom line over here is the 3,600 line, where we touched down. That was our bottom, bottomed around there twice. We just touched this downward trend line. So usually, I won't go too much into technical analysis because in previous webinars, I've been told that I got a little bit too much into the details. But usually when the stock market hits a trend line like this is what you call a ceiling. It will touch it, and then since there are sellers that wanted to sell at that point, there will be new sellers coming in and the market will fall back down again. However, I do see December as being quite good. So I would not be surprised if we break through this trend line. And in technical analysis, when you break through a trend line, then usually there can be a significant rally with there'll be some, but less resistance on the way up. So you could rally quite significantly. The next ceiling, you can say, is this one right over here, where there was selling in end of May, early June. There was difficulty breaking through in August. And then when it did break through, it sold off pretty quickly. And we tried to break through this 4,200 line in September. So I would not be surprised if I had to guess that we will have some volatility in December, of course, but we will end around 4,200 for the year with a rally. That's about a 2.7 to 3% gain from where we are. So that's, I would say, realistic. However, there's the alternate scenario where we have a really good CPI read where we could break through 4,200 and have some crazy moves. So we will see. And third scenario, what I'm not expecting, but it's totally possible, is CPI coming in hotter than expected, which would be bad, and the market crashing on that news and coming back down closer to 3,800 or so to close out the year. We will see, and I will definitely cover it all on January 1st. Very excited to start the new year. So that concludes the monthly market update webinar for this month. I would love to review some of your questions. I got a couple coming in here. I had quickly read them when they came in earlier, but I don't believe, this one's a little bit too much of a personal question. I'll contact you. I'll send you an email, and we'll get you sorted on that. But that's not as much of a question for the entire audience. Okay, so this other question that I'm reading here is about real estate investment. It's a rather broad question about if buying real estate here today with the higher mortgage rates, especially if you have to finance it with a mortgage, is it a good investment, especially if you're looking at a rental property rather than just a personal home? So in general, it depends on your situation. You should talk to your financial advisor. But this isn't a terrible place to buy real estate. Historically speaking, when talking about investment in real estate, the best time to buy real estate was last month. There's always, I've always bought it before. There's no real point in waiting. The big exception to that, of course, was 2008, where there was the housing crisis, but a lot of that was predicated on finances and the mortgage bubble and lots of problems there. This year's, and you can go back a couple webinars have discussed housing bubble and such, but I don't see a housing bubble in 2022, 2023. A lot of the high prices came about with really low mortgages. And now that rates have risen again, demand has fallen off, but supply hasn't really risen either. The home builders aren't building lots of properties. The people that bought houses don't want to then move again and buy a new place and have to pay a huge mortgage. They would rather just stay in their low fixed rate mortgage and where they live currently. So there isn't as much demand currently, and there are high mortgage rates, but supply isn't expected to catch up anytime soon. And since there'll be low supply continuing for likely the next multiple years, I will keep with the historical adage that it is best to buy real estate last month. You should buy it now if you can afford it. And this is, of course, generic advice. Your specific situation may dictate otherwise, but real estate is in general a pretty good investment, even with high rates, because if rates fall, you can always refinance. So pretty good consideration, and I'll send you an email if you want to discuss a little more about purchasing a property. All right, I think that was the only question that is broad enough for the whole webinar. So again, I want to thank you all for attending. It was a great webinar, and I look forward to hopefully a good year-end rally, and hopefully a good time with family. All of you that are either headed home for the holidays or spending time with family that is already around you. I will see you in January, probably not first, since we'll be switching it up. Please again, look out for that survey I'll be sending out. It will significantly impact what day I pick for the next year or when I'm going to be holding these webinars. So again, thank you so much and have a great rest of your night. Bye-bye.